Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Meghan Robson. She's the head of U.S. credit strategy at Paribas, with her expectations in 2023 for the credit markets and expectations for downgrades and defaults as well. Meghan, it's great to have you with us. Welcome to MarketSite.
Thanks for having me.
What's your overall theme for 2023 in the credit markets?
We think 2023 is going to be all about ratings risk. So far this year, markets have been entirely focused on the Fed and rates risk. Next year, we think it will be about the side effects and the implications of that on corporate credit quality. And so we're forecasting a pickup in downgrades, defaults, and we think we will see wider spreads next year.
What about the default cycle? Is it extended, and how deep do you think it can go?
Great question. So we think it's going to be a long but more shallow default cycle. So longer because, unlike previous cycles, the Fed is not going to be able to come to the rescue right away. Inflation's still elevated. But we do think it could be more shallow. And so we're calling for a peak default rate of around 5.5%. This is lower than previous cycles. The starting point for corporate fundamentals is pretty good. We don't necessarily see a clear problem sector that sometimes causes a real big spike, like, for example, in energy or telecom in the late 90s. And so for those reasons, we think it will be a little bit more shallow than previously.
And one of the vulnerabilities that we saw going into 2023 is that companies have really drawn down their cash on the balance sheet. Going forward, do you expect two trends to drive deteriorations even more? What are those?
Yes. So we think that, one, revenue growth is going to slow. So as inflation comes down, revenue growth has tended historically to track pretty closely to the downturn in inflation. And so we expect that to happen. At the same time, we think margins are going to compress. So higher cost pressures, things like wages, and also elevated inventories, companies will have to discount those. We expect margin compression to play out, which will eat into earnings.
Right, so do you think estimates have come down enough for earnings?
I think they're starting to come down, and if you look at S&P consensus, they are pricing in some expectation for margin compression, but we think it needs to come down further.
And is this priced in to the market, and how do you position in this kind of backdrop?
I don't think it's priced in. I think credit is priced for a soft landing. We've been moving wider in credit spreads for about 13 months. We've recently stabilized, and I think consensus believes we will have this soft landing outcome. Next year, if we do have a downturn, which is our base case, spreads will have to move wider. And as this fundamental deterioration starts to play out, we think markets will price that in.
Right, so the Trade Talks audience are largely focused on equities and fixed income. Why is it important for investors to pay attention to credit spreads?
I think a number of reasons. I think that credit spreads, especially lower quality credit, can be a leading indicator for problems in other parts of the economy. So sectors like leveraged loans and high yield, where credit quality is a little bit weaker, as problems pop up in those sectors, you could start to see it filter up into higher quality, things like the Russell and also S&P.
All right, appreciate the insight, Meghan. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.